This is a very interesting document with the, and what we are calling it now is Guidance on Company Capital and Financial Accounting for Corporate Sustainability and Sustainable Business Conduct. Corrado Malberti will present the project in a moment. I will say that I'm very pleased to tell you that the draft was adopted by the ELI Council under the Philip motion, and I won't tell you what that entails, but there could be still some clarifications and small changes, also a little bit of black-letter changes to the project, but it is approved, and it was that on Tuesday this week. The first speaker will be Corrado Malberti, and Corrado will be setting the scene and a presentation of the project. And then Yuri Bondi, and both Corrado Malberti and Yuri Biondi are co-reporters on the project, together with Colin Haslam, who will join us not in person but online, and he will also say, but Yuri will give a more firmly presentation of the draft. And then we will have Sven Gärtner next to me from the head of the unit for corporate reporting and auditing and credit rating agencies in the European Commission, Director General for Financial Stability. I won't say the last things, you can read it in the program, but he will also give us some remarks. And then we will be joined by Kirstine Lopata, who is a professor of financial accounting, and she will also give us some remarks. And then Colin Haslam will join us for a conclusion on the presentation, and then we will open for the Q&A. So as you can see, ladies and gentlemen, we have hard times in front of us. So Colin, could I ask you, Corrado, to...
Thank you very much, Chair. It's a real pleasure to be here today at this annual meeting for the first time since the pandemic. The project we prepared here at the ELI is a project on corporate sustainability and financial accounting. So I will just try to give you some I would say basic information on how the project evolved, and then Yui Biondi will enter more in the details of the project that was approved by the Council 2 days ago. So the project started in the SIG. The ELI has this special interest group, and the special interest group that started discussing this project was the group on business law, on business and financial law. A group that was formed 7 years ago. We had several meetings, several discussions. We had an inception paper where we had our first public meeting, and we then moved forward with elaborating this project. So you can say that this is one of the early projects that really come from the bottom up, I would say. So from, I would say, one of these hubs and SIGs that are organized within the ELI. The main idea of the project is that, to put it really short so that everybody can understand, because here we have different backgrounds, and I guess not many of you have a background in accounting or in company law. So the main idea of the project is that in order to be accountable and in order to benefit the society as a whole, businesses and companies should strengthen their financial stability so that they can pay their debt also in moments of crisis. And this also strengthen not only the sustainability from a going concern perspective of businesses, but also the sustainability with regard to the stakeholders, for example, concerning the environmental damages that may be created by businesses that are operating in our society. To this purpose, we have created a set of recommendations that try to approach the problem using not, I would say, accounting rules, but more company law rules that apply on the accounting framework. To some extent, these recommendations can be interpreted as being similar to the approach we have in the old second company law directive regarding capital maintenance. So we don't want to influence accounting per se. We want to, I would say, suggest correction to the current framework existing in accounting. And so we have elaborated this set of recommendations. The initial title of this panel was Principles. Now it is a recommendation. This was the result of a long discussion we had with the Council and the Executive Committee. We settled for calling the document Guidance and not Principles, and for calling the specific suggestions, I would say, as recommendations and not as principles. We presented this project in 4 council meetings. 3 assessors from the council were closely involved, and Brigitte was among them. And more precisely, we presented for the first time the project in 2020, just before the pandemic, then in 2021, and for two times in 2022. We received feedback from 11 team members of the project, 17 members of the advisory committee, and we also had several feedback from the member consultative committee. So we can say that this is really a choral, I would say, project. I don't want to take any more time. Let me just thank the ELI, the scientific director, for spending much time in providing us suggestions on how to improve the project, and also the Secretariat, and in particular Katia Coleman, that helped us a lot in bringing the ball forward. Thank you very much.
Thank you so much, Corrado. And now we have had a setting of the scene, and now, Jury, it's up to you to present the draft, which is not a draft anymore.
Thank you, Brigitte. So thanks for attending the panel. I will go straight to the content of the report. Corrado has already explained the origin and the context of the project. We wanted to contribute as a SIG and now as an ELI outcome to the current debate on how companies should and may respond to environmental and social issues. And we wanted to address the problem from the viewpoint of the relationship between corporate sustainability, company law, and financial accounting. We built upon what we call the common sense assumption that only financially robust companies are capable to respond to such considerations. So if a company is not financially robust, it will not be able to pay eventually for both the commitment and the liability which are incurred when environmental, social, and governance considerations are under management. And so now we have prepared this ELI guidance which address company capital and use financial accounting as an instrument in view to enhance and facilitate corporate sustainability. And we want to contribute at the regulatory and the legislative work at the European level and of course the national level too, but also to have a contribution to the private law dimension, because the duty of directors and auditors can be clarified, and through our recommendation, if implemented, the legal security of their fiduciary duties can be clarified. And of course, we also suggest some financial accounting adjustments in a way similar to tax law adjustments, which may be implemented to better inform investors and society, but also to better enforce regulatory and legislative action by the European Union and the member states. Among the background research, we have this publication on company law, prudent management, and corporate sustainability by the European Company Law Journal. But we also generate several reports. So the two main reports, one on providing empirical evidence, one on the reviewing the EU framework on sustainability, and 4 country reports on Germany, Italy, France, and Croatia as illustrative case studies to better understand the situation and better address the specific issues concerning corporate sustainability throughout Europe, and also country report from Japan and United Kingdom, which were taken as comparative benchmark. United Kingdom was even a member of the European Union when we started. And Japan was a most important international example because they have a long-standing tradition of connection between company law and financial accounting. We want to learn more about. Our empirical evidence showed our findings were in line with the findings by the accompanying studies of the Inception Impact Assessment by the European Commission on sustainable corporate governance, showing the pressure that many companies, especially the listed ones, receive and face to generate high financial return in short time frame and to distribute a large part of their income to shareholding investors. And excess contribution made result from such pressure, and this could be a detriment of the long-term development of the company and also its sustainability in case, especially in case of distress. We also reviewed the law and regulation on corporate sustainability, and 3 backbones ideas came up, emerged as the building blocks of the European framework concerning sustainability. The idea of the company as a going concern, which Corrado already mentioned, the high level of protection which EU required for employees and creditor rights, but also the emergent idea about sustainable investments, which include environmental and social considerations, and which the EU want to promote and facilitate. At the same time, we find that the current capital management regime is insufficiently clarified and developed because it doesn't mention long-term sustainability of the company, and regulatory competition between the member states could threaten actually such long-term sustainability. And also because that regime was developed before the adoption by the European Union of international accounting standards, and so it doesn't respond properly, it doesn't cope properly with this introduction, which also introduce further current value measurements. We raise specific concern when sustainability and distribution control is under attention. So this policy inconsistency has brought us to stress the limits of the incumbent regulatory framework in EU concerning the received approach on corporate governance, which focus on shareholder rights and shareholder value orientation, with the received approach to freedom of establishment, which neglect this pressure on corporate sustainability, but also the opportunistic use of transnational entities and groups to circumvene some of the problems we raise and we address in the report, and also the received approach to the maintenance of equity capital. So these inconsistencies bring us to stress harmonization to avoid regulatory competition and enhance corporate sustainability and social responsibility, but also to establish a better level playing field for both investors and other stakeholders beyond the received approach based only on shareholder mainly or primarily. So, of course, several possibilities, several options exist, and the current initiative on sustainable corporate governance is pointed to enhancing duties of directors, but the draft ruling is not yet available, but this is what we heard about it. And we will suggest a complementary ruling on bettering equity capital management. And we also, the European Commission and the IFRAG has been working on sustainability reporting, and our recommendation also could help improving sustainability, the reporting, the disclosure on sustainability-related liability and commitments. So what our ELI guidance on company capital and financial accounting does is to provide this set of recommendations to contribute to this European framework concerning corporate sustainability in line with what the European Union has been doing on sustainable corporate governance. I already mentioned it, but also company capital maintenance, which can be restated and upgraded to include this sustainability concern, and non-financial reporting, which could profit by this kind of attention to financial impact of corporate sustainability. Altogether, our recommendation prompt the company to enact a prudent use of resources in two ways. One is by better controlling distribution to shareholders and encouraging provisioning when plans to develop or commit to sustainability plans are engaged by management. But also by paying specific attention to new kinds of distribution, so not only dividend, which are traditional, but also share buybacks and acquisition goodwill. And we also focus on the non-realized gain from fair value accounting, which is another emergent issues. So I could give you just two examples. When a company commits to a long-term investment plan to achieve sustainability, let's see something which has to be done in decades in some case, our principle, our recommendation, our suggestion recommend setting aside a provision to cover for this long-term cost. And when a company recognizes non-realized gains in financial reporting, which can be the case with goodwill, with tax assets, or with full fair value accounting measurements, for instance, we recommend putting these unrealized gains in non-distributable reserve in order to avoid distribution of paper profit. So to conclude, our set of recommendations will restate and modernize the well-established principle of European company law concerning distribution, equity capital maintenance, and non-distributable reserve. This is in line with the ongoing concern and initiative on corporate sustainability at the EU level, and in particular, it can contribute to sustainable corporate governance, company law regime concerning equity capital management, and the going concern principle, and last but not least, the big work which is ongoing at the IFRAG on non-financial reporting. Thank you very much for your attention.
Thank you very much, Yuri. That was nice to have it presented this way. And Sven Gittner, now it's your turn to some remarks and also to come on. I think you would also tell us a little bit on the final agreement on the CRSD.
Thank you. Well, first of all, I would like to thank the European Law Institute for inviting me here today and to give me the chance to talk a bit, as you said, about the agreement that has been reached on the CSRD, which I think fits very well with all of what has been explained now and with the work that the ELI is doing. Before I talk about the CSRD, I would like to take a little step back just to explain a bit in which context the work on the CSRD has been done and in which context the work on the European sustainability standards is being done at the moment. As you probably all know, following the Paris Agreement in the European Union, we have now set legal goals in terms of what we want to achieve in reduction on greenhouse gas emissions, climate neutrality by 2050, substantial reduction by 2030. We have similar goals in other fields, be it biodiversity, be it water treatment, be it waste management and all these kinds of things. Now these, if you want, high-level political sustainability environmental goals are at the same time being broken down into more sectoral, into more sector-specific goals and action plans, if you want. Now, in the financial markets area where I'm active and what I'm talking about today, we adopted a sustainable finance action plan a few years ago. And basically the idea behind the sustainable finance action plan is to make sure that capital markets work better to support the transition to a more sustainable economy. How can they work better? They can work better if they fully understand what companies actually do, when they can fully price in all the risks and the impacts that companies have. Because quite frankly, capital markets did not work properly. Had they worked properly, we wouldn't have an economy that is endangering our lives and the way we live our lives and the future of this planet. So we need those markets to understand better what these companies actually do, what are the long-term risks, and what are the implications also for investments. It's only one part of the picture, it's not the whole picture. We need other rules and regulations as well, but that's basically the fundamental idea what we're trying to do in capital markets. We already have some rules in place in terms of disclosure by financial market participants, so asset managers, institution investors, pension funds, that need to explain to their investors what are they investing in, what are the sustainability-linked risks, and what are the possible sustainability-linked impacts of these investments. So simply put, the portfolio that an asset manager puts together, what kind of amount of greenhouse gas emissions will it produce? What kind of effect will it have on biodiversity? These kinds of things. We're requiring these kinds of information already now, but of course, financial market participants, asset managers, institutional investors cannot provide this information if they don't receive it from the companies they invest in. And that, in a sense, was the missing link. We had already what is called the non-financial reporting directive in place, but that was more or less voluntary, was relatively vague. And we said, well, we have to now produce the framework, we have to put the framework in place that requires everyone, that requires all the corporates, all the preparers to provide the markets with all the information on sustainability that they need to take better decisions. And this is what the CSRD is about. So agreement was reached in June of this year between the European Parliament and Council on this regulatory framework, so Corporate Sustainability Reporting Directive. So what does this Corporate Sustainability Reporting Directive do? Basically, it first of all sets the legal framework to establish mandatory European sustainability reporting standards. And these standards are being developed at the moment by EFRAG, and I think Kerstin in the next intervention will talk about that. So we will have, in 1.5 years' time, we will have mandatory reporting standards for all large and listed companies in the EU to report on sustainability. Now, sustainability for us is both the risk that a company faces, so the risk to their business model, the risk to their revenue stream, all sorts of other things, but also the impact that a company has on biodiversity, on climate change, on water, on land use, and all of these things. Because the CSRD is not a framework that is only directed at investors, it is directed also at other stakeholders. So that society at large, that NGOs, other stakeholders can make up their mind about the performance of a company and draw their conclusions. Customers, suppliers, everyone. What else does the CSRD do? It establishes an assurance requirement. So in future there will be specific assurance on sustainability related matters. We'll start with limited, then we'll move to reasonable. As I said, it concerns all large and all listed companies. In a second step, we'll then also move to listed SMEs and to a certain number of non-EU companies that are active within the EU above certain thresholds. I'm not going to go into all these details. One more important element, of course, we are not the only ones doing this. As you probably know, there are also developments underway in other jurisdictions, and in particular at the international level. The IFRS Foundation has now created an ISSB, an International Sustainability Standards Board, that are working exactly on the same issue, even though, if you want, with a slightly different perspective, because of course the ISSB is more looking at, from an investor perspective at things, less from a general society point of view, if you want. Now, in the CSRD, we're also required to try and align as much as possible with these international standards, respecting, of course, the legal framework that is already established in the EU. So all these requirements that I just talked about in terms of climate neutrality, other types of laws, which will have to be reflected in our standards. And that is a difference to the international level. They are, if you want, policy framework agnostic, at least they try to be. We cannot be policy framework agnostic because we're operating in the EU, and the EU has a very clear legal framework when it comes to these things. But nevertheless, we're trying very hard together with the ISSB to come as close to each other as possible, because of course the companies that will have to report under the CSRD, they're not only active in the EU, at least many of them, they might also be active in many other jurisdictions, companies from outside the EU that will have to report under the CSRD. So there is an interest that we align these standards, or at least make them compatible, so that we avoid frictions, double reporting, and all these kinds of things. Now, I think Kerstin will come in a moment and can talk about the concrete development of the standards. Just a word on the timetable. As I said, the CSRD was agreed in June of this year. There's a strict deadline in the CSRD set for the European Commission to give a first set of sustainability standards to the Parliament and the Council by the 30th of June of next year. There's very little time because, as I said, it's a huge package. It includes a lot of things. EFRAG has been working on it for quite some time already. They will need to give us the draft standards by November of this year. And then hopefully by the beginning of 2024, these standards can start applying in the European Union and clarify much further how companies need to report on sustainability. I stop here. Thank you.
Thank you so much. That's very interesting, and I think a number of companies are already preparing themselves for the standards which are coming, even they do not know yet what will be in them. Kerstin Lopata, thank you for joining us. I've seen you already on the screen, at least a few seconds ago. There you are. Very welcome to you, and we look forward to hear from you the development of the draft ESRS within the EFRAG. So please, the floor is yours.
Yeah, thank you so much, and thanks so much for inviting me. Is the tone okay? Can you hear me pretty good?
Yes, it's fine.
Okay, thank you so much. Okay, yeah, thanks again for inviting me. And yeah, I will explain a little bit our timetable and where we are standing right now. So as Sven Gentner already mentioned, the CSRD gave the mandate to EFRAG to develop a set of mandatory sustainability disclosure requirements. And the implementation of the disclosure requirements will be in 3 stages, starting with companies already subject to the non-financial reporting directive. And therefore, EFRAG is developing right now the so-called set 1, we call it, so set 1 of the disclosure requirements, and we will also work on set 2, and we started that already. And if I say set 1, that will be the so-called sector agnostic standards, and set 2 is more the sector specific standards, and then we go further down to the entity specific standards. And yeah, the EU gave us a very tough timeline. Sven already mentioned that, so we have to deliver mid of November this year. And yeah, as you can imagine, we have a very tough timetable right now. We started the comment period on the draft standards this year, and we received a lot of comment letters, over 700. And I think we can say that is a very good response rate, so we were quite happy with that. We are on our way of analyzing the comment letters right now, and what we can see so far is not too surprising for us, because we had a lot of outreach events, and the views and the opinions that are shared in the comment letters are matching more or less what we got already from our outreach events. The SRB, so the Sustainability Reporting Board, also started, of course, to think up front about some special topics or issues, let me call it like that, and we discussed already a couple of things. I will give you some insights here on some critical things that are mentioned in the comment letter, and we had the public discussion about these topics today, so I'm quite certain I can tell you about that. So some key issues that have been mentioned in the comment letters and also in the outreach events is the number of disclosure requirements that we are having right now. So we have over 130. And yeah, the stakeholders are asking the board right now for thinking about prioritization of the disclosure requirements and also for phasing in, as well as also thinking about how to structure them. Another point is the materiality, and I saw you have that also in your guidance. So I saw on page 21 that you also talk about impact materiality and also financial materiality. I mean, this is something that of course drives us, and Sven, we are within the frame of the CSRD. So we of course have both financial and impact materiality within our standards. What is often mentioned regarding materiality, that the stakeholders want us to give a little bit more guidance how to do the materiality assessment. So we are also working on practical guidance in this area. Another point that is also mentioned is the international alignment. Sven was also mentioning it, that a couple of other standard setters are working on that. So we have that, of course, in our mind, and we are talking with them, and we try to align. But as said, we are in the framework of the EU, and therefore we have some guides we have to follow. Another point is the value chain. So it's often mentioned that it is a little bit too broad, and that the stakeholders also want a little bit more guidance on that. And what is often regret from companies is that the integrated reporting is not possible anymore, but that is what it is. Yeah, so regarding the report, as said, I went through that, and Yuri, thank you so much for explaining it. What I really like is the idea in the report to have better capital management. I mean, capital comes from assets minus liabilities. That's very basic in accounting. So it's also the management, as you said, of these things. And thinking about provisions for sustainability is, I think, a very good idea. I like to read that in your report. And yeah, thank you so much for your attention. That's what I have to say here right now.
Thank you so much, Kerstin. That was very interesting, and I totally understand you must be under hard pressure if you have to deliver by mid-November, and we are many who looks forward to see what comes. Now we will turn to Colin Haslam, who will also be with us online. And Colin, who is also a co-reporter, will draw some conclusions on the presentations. And I hope, Colin, that you have been able to listen to us, and that you can be present now.
Yes, thank you very much. Can you hear me?
Definitely, yes.
Wonderful, wonderful. Well, I think that the presentations today are all moving in the right direction, aren't they? The recommendations arising from the ELI report aim to reinforce well-established principles of European company law in the light of financial engineering and creative accounting practices, particularly, as Yuri said, with regards to the distribution of profit, equity capital maintenance, and the distribution of non-distributable reserves, and how companies can manipulate these reserves to extract value rather than retain and reinvest, specifically with regards to share buybacks and limiting distributions from non-realized gains. And our concern in general is that if shareholder returns can be met from financial engineering and creative accounting practices, this is diverting corporate effort towards representational rather than real productive change. That is, it's crowding out real investment for sustainable growth and hiding the risks attached to environment and climate change. So within the ELI report, the development really is a sort of comprehensive set of recommendations aimed to foster sustainable business conduct through responsible capital management, and therefore also means changes to the general purpose of financial reporting. Now, what I see today from the presentations is that this is really an important foundation and platform upon which the EFRAG project and also the broader projects around the CSRD are now developing. And really, we need to change company law and renew its foundations so we can future-proof company financial reporting, which is now going to blend financial and non-financial ESG information and inform investors about risks attached to their going concerns and broader stakeholders that are interested in sustainability and climate change. That is, this is the foundation and platform that will support the CSRD and the EFRAG NFR directives as we've seen today. And I think Sven also makes a very important point that financial reporting and the changes must be co-produced with the audit profession, because these institutions must now start to provide strong assurance about the non-financial risks attached to capital invested in companies and the materiality with regards to those financial risks. And this is a real challenge going forward. And we need strong company balance sheets if we're going to inflate liabilities and provisions into the future to sustain both companies and the environment. And that's why the principles that we're putting forward and the arguments put forward in the ELI report, the recommendations, are so important to build that platform that's necessary for the CSRD and the EFRAG project. Thank you.
Thank you very much, Colin. Now I will open the floor for questions. Are there any questions? Anyone? Are everybody scared of what is going to happen? And yes, Walter.
Thank you. Thank you very much for those really interesting presentations and the project. It's clearly aligned with many of the topics that we've had to think more about sustainability. I'm wondering if we think about the reporting and we want to have more reporting and more transparency so that all the stakeholders can then make whatever judgments and decisions appropriate subsequently. I am not sure whether in all those instances the decisions will be taken in favor of more sustainability if it implies costs. So for instance, we would like our t-shirts to be as cheap as they are now, and they're produced without, as economists would say, internalizing externalities, many of which are environmentally relevant. So my question for the reporting issues is, to what degree will you take into account the difficulties that companies wishing to actually know in their own self-interest long-term, take about companies with a dominant shareholder who doesn't want to exit? They have all the interest in the world to think about long-term risks. And most European listed companies in many of the large continental European jurisdictions actually have such shareholders. So often these are families or other companies, sometimes foundations. They don't want to exit. They don't have a short-termism issue. And there's plenty of empirical evidence that they actually do not really enhance short-termism. But the difficulty they face is, how do you price those long-term risks? So, for instance, pollution, other externalities, emissions. And my question for the project would be trading schemes and other attempts to price in the costs of externalities. Would that not be the most direct way for companies to then have to make provisions already in the framework we have? Now, if you know that you will have to pay a certain amount via tax, or perhaps even earlier when you buy the product that will cause during your production process all those polluting externalities that are currently left with society, then all the other questions are fairly mute. Now, of course, having more transparency and reporting, I'm all in for it. It wouldn't harm. But would my question here is, to put it more provocative, would that be not a more direct way to actually create the incentives than the other way around? Now, that does not imply that I think what you do has no justification. To the contrary, I think, in addition, it's extremely useful and necessary. Thank you.
Thank you. And there's another question. I think we will collect the questions and then try to answer them. Yes,
Thank
please.
you for your interesting insights. I'm really happy that this missing link in the reporting is finally filled. My only question from the consumer perspective, I'm wondering if a consumer would have a choice to see this reporting or understand this reporting, or would be possible to ask some summary from the companies, which is understandable and transparent for enough for the consumer to make an informed decision if I would buy the products of this company or not. Thank you.
Thank you. Do we have more questions? Well, it seems not now. I think, Sven, would you start answering?
Sure.
Cost issue, yes.
Happy to start. Thanks for the questions, and I think they're very, very good, because that's exactly the kind of things that we've been grappling with as well when we were thinking about this whole topic. So maybe on the first one, if I understood you correctly, is reporting enough, or can it actually achieve what we want to achieve, and do we not rather need also more direct interventions in terms of pricing in externalities? I think that's entirely correct. As I tried to explain also in the beginning, reporting or disclosure or transparency can only be one element, because by itself it will not necessarily lead to a change in behavior, and maybe investors will nevertheless go on investing in the things that they invested before. So on the one hand, I think we need it, because we need the possibility for the companies, maybe also for the companies themselves, to better understand things, at a certain discipline they have to go through, for the investors to better understand, even if they're long-term investors, maybe they didn't have the bandwidth up to now to really get their heads around that. But then on top of that, of course, we do have, if you want, direct interventions also on the prices, on the externalities. I mean, we have an emissions trading scheme. We're introducing limits on CO2 emissions. We're introducing rules on water use and all these kinds of things. And of course, they will then have an effect on the revenues and of the potential future of these companies. So I think the two things have to work hand in hand. We have, if you want, sectoral strict rules on behavior, on limits to emissions, on other ESG-linked topics. And in addition to that, we have the reporting disclosure requirements that make all of this transparent, and that require the companies to disclose very clearly also, if you want, the legal and the regulatory risk that they face. Stranded assets, I mean, that's one of the words bouncing around, where, I mean, certain companies, it's pretty clear that their business model in, say, 10, 15 years will not be viable anymore, because everyone knows that under current rules, and in particular under future rules, they will be priced out of the market. And the rules that we're introducing now, I think they will bring a lot more transparency and light to that. So the two need to go hand in hand, definitely. Maybe on the second question, very briefly, but maybe Kerstin also wants to come in. I think our hope is that, first of all, of course, the reports in themselves will be understandable. But on top of that, I think also a certain number of intermediaries and third parties will have to play a role to kind of, I don't know, let's take a very simple example, maybe based on the question before. If you're a consumer, if you buy clothes and you would like to understand, I mean, the company where I'm buying the clothes from, do they actually respect labor rights? How do they treat their workers and all of that? There may be information in the reports. Maybe it's difficult for you to understand, but I'm pretty sure that there will be intermediaries out there in future that will look at exactly these aspects and will maybe also compare companies and say, look, based on the disclosure that is being done, we can pretty surely say that these kinds of companies have relatively well-established practices, and the others we're much more doubtful about. And there, I don't know, there might be rankings, there might be other kinds of instruments. So I'm quite sure that the information that will be provided will be used by different stakeholders and also for the benefit of others.
Thank you very much, Sven. Yuri, would you also comment on, and then maybe Kirsten first, and Yuri? Yes, let's do that, Kirsten. If you would comment first, both on the transparency issue and, of course, the costs. Yeah.
Yeah, thank you so much. Just adding on to what Sven already said. So regarding the financial the costs you mentioned, there are two meta studies that show that financial performance is positively related with ESG performance. And I think that is a very good sign. I said two meta studies, one is very current. The second point I would like to mention is that of course, we have costs, but we have also benefits. One I already mentioned. The other one is that you see that already shareholder engagement shows that proxy voting also goes into the direction of ESG reporting. And I also think that market pressure will solve a lot of these things you already mentioned. Regarding the consumer, I mean, I think will change how the way companies will report and also what they report. And I think you need to look as a consumer more for labels in this area if you would like to, see really what's going on within the companies. Yeah, thank you so much.
Thank you very much. Jury, would you?
Thanks, Walter, for your questions. I want to come back to the Sven points at the beginning when the EU framework concerning sustainability first engage with financial actors to have better disclosure and to encourage them and to prompt them to become more sustainable in their portfolio management. And of course, the complementary point would be to ask the companies which are in those portfolios to better disclosure, to also engage in sustainable business conduct. So I think therefore the Commission is now doing on sustainable corporate governance and sustainability reporting by the EFRAG, comment on those complementary parts. We are focusing on company here. So you were mentioning how market-based incentive can price perhaps some of this risk, and we have a scheme for CO2 emissions. But at least our belief when we start working on this project that this market focus is not sufficient at least, and we cannot believe to live in a complete and efficient markets. So markets are incomplete and are the limits. Sometimes can even be highly dysfunctional, and we assisted to this several times actually in the last 2 decades. So I think the corporate dimension is very important, and this we welcome, of course, as our project in ELI welcome the initiative of the European Commission and the EFRAG, and we want to contribute to their work by also pointing to further possibility, provide some suggestions how to go even further by helping managers and for course long-term investors. You are right that shareholder investor can be willing to engage, and I think the regulatory framework can assist and facilitate their engagement, including by our own suggestions. Thank you.
Thank you very much. Corrado, would you have any comments to the questions you would like to add?
Not really, I would say.
Not really. Colin?
Yes, I would just reinforce the point that was just made, which is that for example, emissions trading schemes have not been overly successful, and they're really about reallocating carbon credits from those that are in surplus to those that are in deficit. Whereas what we now need to do, given the challenges with reducing carbon emissions going forward, is to change corporate behavior around the reduction of absolute carbon emissions going forward.
Thank you. There are probably more questions from the audience, but I had one question actually, which was, now these rules, when they are implemented, they will deal with large and listed companies, as I understand. And but you also said that you would look into perhaps afterwards the small SME companies. What are you thinking about that? When will that come about?
So originally the Commission had actually proposed to include the listed SMEs right away. In the agreement reached between Parliament and Council, we now have a several phase approach. We start with the companies that are already or were already subject to the NFRD. Then the other large and listed companies come in, and only then afterwards will it be the listed SMEs and also the non-EU companies that are above a certain threshold of activity within the Union. I think the rationale from the Parliament side in particular was that they didn't want to overburden SMEs, that they were worried that if we put too many requirements on them, it might become too costly and all that. From the Commission side, we've always argued and said that any kind of listed SME in particular, but maybe also other relatively large ones, will in any case have to do this kind of reporting, because their banks will require these kinds of information, their investors will require this kind of information, their customers might require this kind of information, others might require this information too. Now, if they're subject to 4 different kinds of information requirements from different stakeholders, it's probably much more complicated than if they're subject to one coherent set that will develop. But okay, the political compromise was, let's start with the larger ones, let's move to the listed ones afterwards. So EFRAG will then also develop specific standards for these listed SMEs, and we will probably then also on top of that issue some guidance for non-listed SMEs who will not be required to report according to these standards, but who nevertheless may want to report, and will give them some guidance on how this reporting could be done, also to bring some coherence into that field. But again, that will be strictly voluntary.
That's interesting. So it's so actually what you expect is that this will go down through the system. Actually, once we start with the big companies, then the smaller ones will take on.
So in the law, there is a clear timetable who will have to report when, according to what standard. And as I said, it goes down to the listed SMEs. But I think even without the CSRD, many of these requirements will be put, or are being put, or will be put on companies in any case, because lots of stakeholders, banks, investors, and whatever want this. I think that the CSRD and these ESRS, these new standards, are now a possibility, an opportunity to create a coherent set of standards, and also to make it easier if they want to, for the preparers, that they know exactly what is it that I'm required to do, and not have to deal with different stakeholders in different ways, and the bank wants the one thing and the investor wants the other thing, and another stakeholder wants yet another kind of information. I think that would be the ideal, that afterwards we have a basis on which everyone reports.
Thank you. Corrado, you?
Yes, maybe just a question, since you were mentioning the listed SMEs. What is an SME? I mean, that's the real question. I would say, you know, that there is this debate going on since many years. Should we keep the definition of the recommendation, or should we define SMEs as being a small listed SME? So even if you extend the scope just also to listed SMEs, the scope then will remain to some extent quite narrow. Or are you considering extending the scope also? Because to my understanding, the final conclusion of the debate on the definition of SME was to keep, I would say, the old approach and not to move toward a new one.
No, I mean, we stick to the definition that we already have in our law, and I think for the time being at least will not move to a requirement beyond what is in the legislation now. As I said, I mean, the Commission proposes the law, and then afterwards Parliament and Council, as the democratic co-legislator, negotiate this. And I think what they try to do, and which we of course also agree to, is you strike a balance between trying to push this relatively far to make sure that it applies to a large number of companies, but at the same time also recognize that maybe certain types of companies have more difficulties dealing with these requirements than others. Having said that, and I said it already, but I have to say it once more, I think in one way or another, most companies, at least down to a certain size, will have to deal with this kind of reporting, because society at large, stakeholders, banks, whoever, will expect it of them in any case.
Do you see any difficulties in the present situation by implementing it? Because now we are having a inflation, and interest is increasing, so there are a lot of burdens on the companies, and of course also with the war in Ukraine. So we have a number of issues which might tackle the ESG agenda and also the sustainability agenda. So I was wondering, how long do you expect the implementation of the directive will be? Will it be a minimum directive, which will then again create some problems?
Well, maybe a few elements. I think there's maybe a difference between the short and medium term. I think everyone agrees that medium term we definitely need to move in this direction. And if anything, the current situation has reinforced the case for more sustainable, at least energy production, because we all see what happens when we're dependent on fossil fuels, not just in an environmental sense, but also in a political sense. But of course, in the short term, it creates a lot of pressure on the companies It creates a lot of pressure on our economy. And I think what Kerstin also described, the kind of feedback that they got now in the consultation, that the company is saying, well, do you really need to start with the whole set of standards? Can you maybe differentiate? Can you do some phasing in and whatever? I think these are the topics that are at the moment being discussed also in the SRB, in the Sustainability Board. Again, I think in the medium term, we'll have to do this. And if anything, the current situation reinforces the case for it. But of course, at the same time, we need to be mindful not to overburden the companies and also to create a path on which everyone can manage to get there. It wouldn't be a good outcome if then companies simply tell us, we cannot do this, we can't cope, it's too much, we don't have the resources and all that. But I think there are ways to get there.
Thank you. Kirsten, I was wondering whether you would say, you said this on the number of stakeholders who had actually already filed some comments and a structure on this, the group of stakeholders, whether you could sort of come with a few more comments to that issue, and of course also some of the other things which has been said here by Sven and Corrado.
You mean of the feedback we got already?
Yes. But also
Yes.
the structure, and you said you had it was quite a lot, as I understood you. I noted 130. Maybe I was wrong, but you had many comments as of now.
Yeah, as I already said, they're usually going into the same direction. I mean, we have multi-stakeholders on the board and as well as in the comment letters. So, of course, opinions sometimes go in different directions. Some wants more, some wants less. What we can see is, I said that already, and maybe I stress it again, so that the materiality assessment is, of course, a very important and very crucial point. So within the board, we are thinking right now about the so-called presumption. So what we have right now within the ESRS is if you can't report one data point, you have to explain why you're not reporting that data point. And within our comment letters, we also saw that is a very critical point because companies, you mentioned it already, there are a lot of costs at the moment coming into place. So companies are also saying that should be overthought, and we did that already. And we are working on something that we think of implementing standards, of course, that have to be fulfilled by every company, but not going with the rebuttable presumption right now. As it is framed right now, we are thinking about a different approach. We call that the so-called implicit approach, where we say, well, regarding to the materiality approach, the company should report what is material. We are thinking of if they should name the non-materials. We have no on that. That was in the discussion on the board right now. We are also thinking, and that was brought into the discussion by ESMA, for example, about a materiality assessment that is more or less free. I mean, it can't be free. Sven explained it, I said it too. We have the CSRD and the SFDR requirements we have to fulfill. But yeah, so as said, so the rebuttable presumption was one point that was heavily discussed also by us. Another point is the structure we are having right now in the ESRS. We are not following exactly the TCFD structure. We derived a little bit. Also, that was a discussion point because companies, I mean, the companies that come in first are the companies that apply or that under the NFRD right now. And most of them following regarding climate, of course, the TCFD. And we were also asked to think that through if we could change our structure, and we did that already. So we were discussing that too. As said, just lowering the burden a little bit for the companies because they know already the TCFD, and also to align with the ISSB and showing that we are want to align. This is also a point I would like to mention here. Thank you so much.
Thank you very much. I have a final question, and that is actually, how do you look upon the enforcement on this? Will it be will there be some carrots or will it only be sticks?
I mean,
Sven, would you like to comment on that?
Wood at the end.
well, of course. course, there's a usual framework in terms of enforcement. First of all, as I said, there will be an assurance requirement. There will be enforcement also with supervisors who look at these things. I mean, I think there's a certain market discipline which will also have an effect where stakeholders look at this, investors, others. Maybe the carrot then is that if you do this, it probably opens up kind of new avenues and a new future for your business. Again, as I said, I think if you don't do this kind of reporting and if you don't do it well, you will have a lot of difficulties in future to run a viable business. So, but we haven't included any financial benefits or incentives in the legislation, obviously.
Or penalties.
Huh? Yes.
Yes. No, it was just because there's always an enforcement issue to all kind of.
No, and it's
yeah.
and you're right. It's particularly difficult here because I mean you've probably also all followed these debates about greenwashing and all sorts of companies portraying themselves as being sustainable and rather not being it. And there is no magic solution to this. Like there is no magic solution to other areas where people engage in these kind of dishonest practices. I think what will be important is first to put the pressure on them, to make everyone, or require everyone to substantiate these claims and to move beyond this mere, well, we're green because we put out green marketing. Of course, there need to be penalties, and there are penalties. But of course, there needs to be also, I think, a certain development or involvement in the market as a whole. It is still relatively new, and a lot of the things that we're seeing now, it's just a beginning. So I mean, investors will learn, the companies themselves will learn, supervisors will learn, but these kinds of frameworks that we're establishing now, I think they can be the basis for all of this. They will not in themselves, I think, magically solve that problem, because of course there is a big incentive to claim that you're much greener than you are, because then you keep your costs low and you nevertheless try to attract the whatever customers. But I think it'll help us get there.
Thank you very much, Jury. I was wondering whether you will say a few words before we close the session.
I think I cannot but thank all the participants for being here and discuss with us our findings and our modest recommendations. And I want also again to congratulate you on the tough work we have been doing to promote and encourage corporate sustainability in Europe. So thank you.
So I'd like to close the session a little bit earlier than expected, but then you have a break before the next session. And thank you very much.